Hello and welcome to the lecture on Chapter 7. This chapter deals with internal control, which I know you've had lectures about in Accounting 201, in Accounting 405, probably in Accounting 301 as well. But I want to take a different approach to the subject in this case. I want to look at internal control from this perspective of an auditor. So why does it matter to an auditor? That'll be the key focus of this chapter. So we'll talk about the meaning and significance of internal control, the considerations that it poses for financial audits, and I'll talk about the major components of internal control. Some of that's a little bit of a review, but I think it's worth doing for sure. Lastly, I'll talk about communicating internal control related matters to management, kind of what form and process that takes. So the Foreign Corrupt Practices Act of 1977, that's a U.S. federal law, and it deals with people that make bribes to earn business in foreign countries. Now that may or may not be legal in the foreign country, but it is illegal for any American business to do that. The penalty is fines and prison time for business executives. So it's something that should be treated very severely, or seriously rather. So this particular act put in place a requirement for internal control, and this kind of predates Sarbanes-Oxley. So it described internal control as a requirement that all transactions are executed with the knowledge and approval of management. So there needs to be a system in place so that rogue agents within a company can't do something inappropriate without management's knowledge, that transactions are recorded properly for accurate reporting so that there's a trail that you can determine if this kind of activity happened or not, that access to assets is limited to authorized individuals, and that accounting records are compared to existing assets. So there's some form of reconciliation to make sure that illegal payments aren't made without the knowledge of management. Now, a definition of internal control that we found in the book, I'll read it verbatim because I think it's important. Internal control is a process effected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives in the following three categories. 1, reliability of financial reporting. 2, effectiveness and efficiency of operations, and 3, compliance with applicable laws and regulations. Now, a couple words here I want to talk about. First of all, reasonable. This should kind of jump out to you as similar to the language that we talked about in terms of the assurance that auditors provide about financial statements. It's not absolute, it's reasonable. The primary reason for that is cost-benefit considerations. So we can't provide absolute assurance about achieving objectives because it's too costly. Now, reliability, and the other point I want to make is objective. So that's more broad than just financial reporting, okay? So reliability financial reporting, that's making sure that there is a system in place that will catch either intentional mistakes, which would be considered fraud, or unintentional mistakes, which would mean errors made by personnel. Efficiency and effectiveness of operations talks about meeting company goals, achieving objectives. If the company has a strategy of entering a new market or creating more efficient manufacturing or strengthening their supply chain or whatever the case is, they'll have policies and procedures in place to achieve those goals. And it's making sure that everybody is kind of playing from the same set of rules. And then compliance with applicable laws and regulations, that deals with financial related laws and other kinds of laws that would pose risk to the company if they were violated. So there are three different categories of achieving internal control. The one that you're probably most familiar with from past courses is preventative controls. We talked about that in Accounting 405 when we talked about restricting the ability of people to do certain things within the accounting system based on their job title, which we effectuate through the way they log onto the system. So if I log onto the system and I'm an accounts payable clerk, I don't have access to payroll. I don't have access probably to doing adjusting journal entries or cash receipts. So that's one type of preventative control, restricting access to different kinds of activities. Another example is separation of duties, so making sure that people in the chain of transactions aren't doing all of those, that different people do different portions of them. Making sure that there's some requirements for approval for certain kinds of activities. Job rotation, requiring 2 signatures on checks over a certain amount. Those are all preventative controls. We're trying to keep a mistake or fraud from occurring. A detective control is where you try to uncover a mistake or fraud that's occurred. And there are 2 benefits to detective controls. One could be that the mere existence and knowledge of the fact that there are detective controls would prevent somebody from considering committing fraud, or maybe be more careful about making mistakes. If I know that the controller of the company is doing bank reconciliations, then maybe I'm less apt to try to slip something through the bank that's inappropriate, as an example. So reconciliations, physical inventories, surprise audits of petty cash, all of those things are detective controls. So one benefit, as I mentioned, is the fact that they exist might inhibit somebody from choosing to do that kind of behavior. The other benefit is that you catch mistakes and fix them. The other is the last one is corrective controls. So that's making sure that you have something in place where you can unwind something and do it over again. So primarily having proper backups in place. So the elements of internal control, different books use different terms for them, but they basically fall into these 5 categories, and I'll talk about each in more detail. The control environment within the company's approach to risk assessment, the different control activities, which is kind of the bread and butter of internal control, the accounting information system, and then monitoring activities. So the control environment, some books will talk about this as the tone at the top. So what is the position of senior management in the company about integrity, about ethical values? Do they have a code of conduct? What is their opinion about internal controls, and how is that conveyed to the rest of the staff? Again, if as an auditor you come into a company that has a cavalier attitude about internal controls or lacks integrity, then that should be a major warning sign to either not take the audit or to do a considerable amount more of substantive tests. Does a company have an independent board of directors? If the board of directors is dominated by the owner and his or her family members, then there probably isn't proper independent objective oversight of what the company is doing. So again, the more independent the board of directors can be, and in particular the audit committee within the board of directors, that's a key factor that an auditor would look at. Does a company have an effective organizational structure? Are there clear reporting lines? Do people know who's responsible for what, who they report to, all of those kinds of things? Is a company committed to attracting, developing, and retaining competent employees? So incompetent employees, or if they have high turnover employees coming and going, it can be really difficult, particularly in the area of having errors not be made, having quality work be done. And then what's the company's position about holding employees responsible? So if you, in casual conversations with personnel at the client's facility, find out that there has been fraud in the past and people got away with a slap on the hand, that's going to be an environment that is more apt to have more fraud than if it's dealt with severely and publicly. So risk assessment, we'll look at this kind of more broadly than we have in the past. And so this is risk assessment. It's management's process for identifying, analyzing, and responding to risks from internal and external sources. So an internal source might be the loss of a key employee, the failure of a significant machine, those kinds of things. External sources of risk might be moves that competitors might make, government regulations that could have a negative impact on the company, supply chain difficulties that would cause problems for the company to meet their objectives. So those are all different kinds of sources of risk, and the company should take an approach to look at the likelihood of occurrence relative to the impact of the occurrence. So if it's unlikely that it'll ever happen, and the impact is relatively minor, it can be a lower priority than if it's likely to happen and has a high impact, so it's multiplicative. The other view of it is how quickly is it going to happen, right? Is it something that we're going to see coming down the road and have plenty of warning about, or is it going to pop up and hit us in the back of the head? And then what's the duration of the impact? Is it mean a bad week, a bad month, a bad quarter, or a series of bad years if it happens? So one thing I thought about this portion of the book that would be kind of an interesting thing to consider is I think their approach to risk management is almost more of an approach that somebody within the company would take. So that's where we talk about processes, ways to respond to risk, and enterprise risk management. I'll talk about those because I think they're interesting, and you may work in a company one day and have to think about these things. But I think from an auditor's perspective, we would look at it a little bit differently. If a company had an unreliable supplier and that would cause them production disruption, I don't know that that's something that would rise to the level of something an auditor would insist on reporting in a financial statement. So I would kind of water it down a little bit in that regard. So the steps a company, or the responses a company can take to a risk is, one, they could avoid the risk by exiting the activity. If I have an unreliable supplier and there's no other supplier I can find, maybe I stop selling that product. Just avoid it. One, I could adopt strategies to reduce the risk. So if I have an unreliable supplier, maybe I find 2 other suppliers that can back that supplier up, and I spread my purchases among 3 suppliers so all my eggs aren't in one basket, in effect. I could share the risk by either insuring, hedging, or outsourcing. Or I would add insourcing, bringing something in the factory if I don't have reliable suppliers outside the factory. Insurance is the key one there. You can insure just about any risk that a business faces, and that's effectively transferring the risk to somebody else. Or I could just accept the risk and say it's a cost of doing business. There's no way to avoid it. We just move forward and hope for the best. So enterprise risk management is a systematic approach to looking at what can go wrong in a business and what do we do about it before it happens. So there's a couple of benefits to this, and I won't go into it in great detail because, again, I think it's more of an internal management focus than an auditor focus. But the 2 benefits of taking an ERM approach to business is, one, you may be able to adopt strategies to avoid risk before they happen. That's good. Or second, you could adopt strategies so that when a company is confronted by a risk, they've already thought through what their response might be and they have a plan ready to go rather than thinking about it for the first time. So control procedures, this should be something that you've certainly talked about and seen in the past. So one is having competent trained personnel. That's important. Having a procedure manual, a written procedure manual for all jobs within the accounting department is critical. So you can't really hold people responsible for doing their job right if you don't clearly tell them what that is. Making sure that you have rotating duties and or mandatory vacation so that you have different people sitting at the desk doing the job. Just that mere fact is going to lessen the chance that somebody's going to do something inappropriate. And fidelity bonds are a type of insurance that you can take out that protects the company if a particular employee embezzles funds. So that involves an insurance company investigating that employee before they're willing to issue the bond. So having a policy where you have fidelity bonds for all accounting personnel is a good thing. If you do that as part of the hiring process and are upfront about that, somebody that's got skeletons in their past would probably just not apply for the job. So separation of duties for related operations. Again, you don't want somebody to open the mail, endorse the check, take the deposit in and enter it in a cash receipt in the accounting system. Those should all be done. Each step should be done by a different person. That can be a challenge in a small company, but you have to just get creative about how to do that or involve the owner in some of the steps. Separating authorizing transactions from recording those transactions and having custody of the assets. That's critical as well. Performance reviews are important so people get feedback. Proofs and security measures, so that would be An example of requiring somebody to approve something, we had a variety of proofs that existed within Microsoft Dynamics and Accounting 405. So making sure that you can't enter an order for somebody that has a credit hold on their account, all those kinds of things. And then physical security, that would deal with both locking up inventory and restricting access to it. We'll talk next chapter about restricting access to computer systems and also having sign-ons, passwords, sign-offs, automatic sign-offs, that sort of thing. Next, accounting information systems. So that it deals with making sure you have a system that can use relevant quality information to support other internal control functions. So making sure that you have a system that kind of enables internal control to operate properly. Making sure that your accounting system communicates the necessary information internally so people have the information they need to be able to do their jobs and execute internal control. Making sure that you can communicate things externally properly. And then here I mention again the importance of having a manual of accounting policies and procedures. Should be a 3-ring binder. There should be references to jobs, not individuals. So that's important. Monitoring, that's checking up on the system of internal control and making sure that it's operating properly. A good internal control system is never really going to be done because your way of doing business is going to evolve, so your internal controls need to evolve along with it. So you can never really say, yeah, we've got it done. We can put that binder on the shelf and not think about it. So that's the key thing here. So making sure that you have a good quality system, making sure that you have procedures that make sure it's functioning as intended. So are people following the system that you put in place, or are they circumventing it? And making sure that we have a way to communicate deficiencies to the appropriate level of management, which is usually one level above what the problem is. So some of the limits to internal controls, one is human error. People, if your processes involve people, they're going to make mistakes. That's how it is. There could be deliberate circumvention of the system. The higher up in a company that occurs, the more difficult it is to detect. That could be falsified documents, could be a variety of different things. Management override. So one way to find that is looking at the source of a particular transaction. So are senior levels of management involved with making adjusting journal entries to the financial system? That would be a red flag. Okay. Collusion is 2 or more employees working together to circumvent rules. That's very hard to detect. And then cost-benefit considerations. So it doesn't make sense to have armed guards protecting the office supplies to keep them from being stolen, is an example of that. So an auditor's assessment of internal control. So they'll look at the control environment. So they'll interview management. They'll interview rank and file employees, see if there's agreement between what both are telling them. They'll look at the policies and procedures. So show me your accounting manual. Let me read through it. That might involve flow charts, all of that. And then also interview personnel, as I mentioned earlier. In terms of risk assessment, there's some questions we would ask as an auditor. Have there been any changes since the last auditor, since the last audit, either in terms of how you're operating the company or how the company is being regulated? Are there new laws in place, or have you changed your methods of production, or whatever the case is? Have there been changes in senior personnel? Why did the old person leave? What is the new person's background? All of that. Are there changes in either how they do business, the products they sell, or the activities they engage in? Have there been any significant corporate moves like restructuring? Have they acquired suppliers or distributors or lateral companies? Have they divested any of their investments? And are there any new accounting principles that they've put into effect? We'll look at control activities. That can be done through a questionnaire and observations. So I'll show you an example of a questionnaire shortly that you would use in that respect. In terms of accounting information systems, we would ask questions like, if an error is made in a transaction, how is the correction of that error handled? Who does what? Kind of documenting that. What are the exact procedures used to prepare financial statements? So start with the financial statements and work backwards in terms of who does what, when do they do it, what's the sequence of steps. That's going to be different in a lot of different companies, so asking questions and documenting that is important. And then in particular, pay attention to transactions that don't happen all the time. So selling fixed assets, incurring large debt, stock transactions, things that don't happen every day. How are those kinds of things happened? And where there are estimations involved, who makes those estimations and what's involved in making them? Again, you want to make sure that they're made honestly and objectively, not in an attempt to skew the bottom line one way or the other. In terms of monitoring, who are the internal auditors in the company? If the company is big enough to have an internal auditor, how independent are they? What is their skill level? All of that. So here's an example of an internal control questionnaire, and you can see it relates to a particular cycle. So there'll be different questionnaires for different cycles within the business, whether it's production or acquisition, or in this case, it's cash receipts as part of the sales cycle. And it's very clear going through. These things are going to be the same in every business. So that's why a checklist or questionnaire can make sense. So going through, do they do this or not do this? Yes or no? And then making remarks. So an entry-level auditor would typically do this kind of a thing before year end comes up. And every firm would take different approaches to that. In addition, they might also document either the client will have a flow chart of what the processes are for a particular function within their business. This one appears to be cash receipts. So the client may have prepared a flow chart like this, or the auditor might prepare a flow chart like this to get their head around an understanding of what's done, what the steps are, what the approvals are, that sort of thing. So an auditor's consideration of internal control, it's going to be part of getting an understanding of the environment so that we would know what kind of risk we're dealing with. So that's getting an idea of the client and its environment overall. Then we'd get a specific understanding of internal control, which would inform assessing the risk of material misstatement. That's going to influence the further audit procedures. So is it okay to look at 15 accounts receivable accounts, or do we need to look at 50? That sort of thing is going to be influenced by the risk that we face, which is then influenced by internal control. So this just continues on. If we would perform more tests, and if we wouldn't, then how would we get to the end point? So communications regarding internal control, there's a figure 7-11 is an example of a letter to management about deviations from internal control. So there's 3 different levels of deficiencies. One would be less than significant deficiency. That's a minor deviation, so it's not going to be part of the consideration by auditors. If we think it's important, we'll communicate it to management, but it kind of is a nuisance level. A significant deficiency would mean there's a possibility that it would lead to a misstatement that we would communicate to management. And there's, like I said, an example of that in 7-11. And then there's a material weakness. That's where something, there's either a lack of an internal control or an internal control that's not being properly followed that would result in a high probability of misstatement. So that would absolutely be included in a letter to management. So the overall approach to the audit of internal control, again, for publicly traded companies, you're required to audit both internal control and the financial statements of the client. That's called an integrated audit. So we'll plan the engagement of the audit of internal control, and usually what we do in that audit is done concurrently with the financial statement audit. We use a top-down approach, so we start with financial statement controls and work our way down to transaction-related controls. We're going to test and evaluate the design effectiveness, so Are the internal controls designed in a way that they would capture or catch what we need them to? That's one question. A second question would be, given the fact that they're designed effectively, are they operating effectively? So are people actually complying with the internal control procedures that we put in place? And then we would form an opinion. Again, this is an opinion about internal control. So that's the end of this lecture. I appreciate your attention, and I'll talk with you during the lecture for the next chapter. Thank you.